Okay, I think we just got things started. Well, welcome everybody to our first ever Belong webinar, focused on the most critical topic of today, interest rates. I think we're gonna give a couple minutes for folks to trickle in. I think we're already actually, wow, it's a bit of a flood coming in already. Okay. Well, maybe while we wait a minute or two to get started, I think we'd love to get a sense of who all is on the line and who's joining us for this conversation today. I think it feels a little funny that John and I are sitting here and it looks like just the two of us, but there's sort of, it looks like 50 folks already, which is awesome. So as you're kind of coming in, let us know where you're joining us from. These are sort of all of our Belong markets, but obviously no folks are interested in the current economic situation everywhere. So take a look at the poll on the right. Okay, we got one in Northern California. SoCal. Okay. Ooh, this is fun.
Coming in fast.
Wow, where's Florida? Come on, guys. Okay. So we've got so far about half of our attendees are outside of our main Belong markets. Then we've got a big chunk in California, of course, Washington, and surprisingly no one yet in Florida. Okay. Let's do another quick question while we get ready. So obviously we're going to spend today talking about interest rates, but would love to get a sense from folks while we're waiting to get started on sort of what aspects of that are kind of most interesting and most top of mind for you. Okay, poll number 2. I'm most interested on the impact of interest rate changes on your primary home, your rental properties, sort of the housing market in general. Okay. So it looks like most of this group is interested in kind of the impact on the market more broadly. We probably won't get into answers that'll be terribly specific for any one home today, but I think we can always follow up offline too. And it looks like our winning region is probably Southern California coming in today. Okay, well, we're up to about 75 folks, which is awesome. So I think let's go ahead and we'll get started. So I'm Celeste. I lead the marketplace at Belong. Prior to joining Belong, I was a partner at the Boston Consulting Group here in the Bay Area. And I'm joined today also by John Martin of JDM Asset Management. John's sort of a career asset manager based in LA, and he's managed well over $1 billion in real estate assets for sort of bigger institutional clients. But over the last few months, we've actually been lucky to have John working with myself and with the product team here at Belong to sort of adapt financial planning and asset management approaches for the everyday rental property investor. So folks like most of our homeowners who have kind of 1 or 2 rental homes. So as part of that, John's been sort of spending a lot of his time partnering one-on-one with Belong homeowners to sort of run the numbers on their properties, help navigate strategic decisions, et cetera. Thanks so much for being here, John.
Yeah, absolutely. Really happy to be here. It's been incredibly rewarding to, shift my focus towards supporting, smaller scale real estate investors, particularly given, the crazy times that we're all navigating. Every single consultation I've done and had so far with a Belong homeowner has stirred up questions about today's interest rate environment, which is, of course, why we decided to host this conversation as quickly as possible. Um, of course, the classic disclaimer here for this webinar, this is just a conversation and commentary on current events. It's not personal financial advice. So just a heads up.
Absolutely. Okay, so without further ado, let's dive right in. We'll plan to spend about 10 to 15 minutes giving sort of an overview of the recent interest rate developments and the implications for the housing market, and particularly the implications for folks like all of you who are holding rental property investments. We'll address some of the most common questions that John's been getting in conversations with our homeowners. And then we'd love to just open it up for any questions from this group. So we'll try and keep this to about 30 minutes. I know everyone's busy, it's the middle of a workday, but we're also happy to stay on longer and keep chatting if there's more questions to get through. So feel free to submit any questions along the way. There's a chat function on the right side of your screen, and our moderators can see them. So we'll sort of start queuing those while we go through things and get to them in the end. And lastly, I think I mentioned this a little up front, but for any more kind of nuanced questions that are specific to your individual properties, we're happy as always to follow up offline. We can do one-on-one consultations with John and with our team to help work through any questions you have on your property specifically. Okay, so let's dive right in. As you're all, of course, aware, interest rates have risen sharply in the past few months. We've had over a decade of historic lows coming out of the Great Recession. And then in 2020 and 2021, the 30-year mortgage rate had fallen below 3%, which further fueled sort of the incredibly hot pandemic housing market. And frankly, this started to feel sort of bizarrely normal, especially to millennial buyers, first-time home buyers, nothing else. But as inflation became a looming concern, rates began to creep up over the fall and the winter, and then sharply sort of accelerated this spring as the Fed took its first steps to boost rates in March. By the end of May, interest rates had actually doubled from the 2021 lows that I just described, reaching well over 5% for the 30-year fixed. And it's continued from there, but we'll get to that in a minute. Because it's worth sort of grounding ourselves in the fact that historically speaking, rates are still super low.
Yeah, Celeste, 100%. It doesn't feel that way because, like you said, we've gotten very used to cheap debt. But in the 1980s, rates briefly spiked over 15%, believe it or not. It's a similar story in some ways as the Fed was battling record inflation. And then even more recently, rates before the Great Recession were about 5 to 6%, like what we're seeing already this summer. But what you're really seeing in this chart here is rates have just come down and down for about 20 years now, which has fueled a rise in asset prices and tremendous equity gains for a generation of Americans who have had money in real estate along this journey.
So that's a little of the history, and then bringing us back to today. This month has been crazy. So over the course of June, things have become even more dramatic. The release of May inflation data really showed that we're not out of the woods yet, and the consumer price index for May was up a whopping 8.6%. That announcement sort of sent a resounding message that inflation was far from subsiding. In fact, it was and is still accelerating, which is not obviously what economists wanted to see. So expectations of further rate hikes and fear of a potential ensuing recession, which we're hearing more and more about, pushed the stock market into bear territory earlier this month. And the 30-year mortgage sort of accelerated upward again. So we saw the fastest weekly increase recorded about a couple weeks ago since the 80s. So about 2 weeks ago, these expectations came to fruition in a real way. So Fed Chair Jerome Powell announced a rate hike of 75 basis points. This was the biggest adjustment we've seen in a single move since '94. And it was higher than the 50 basis points that was originally expected. So with inflation not yet plateauing, more rate hikes will be on the horizon for July and beyond. So that being said, everyone is really expecting these meaty rate hikes at this point. So this expectation's already been priced into the mortgage rates we're seeing. The reason we saw this much sharper acceleration in June was because the May numbers were worse than expected, right? Everything in economics is relative to expectation. So looking ahead, we can sort of cautiously hope that the mortgage rates won't continue rising far beyond what we're seeing today, which is, with the 30-year fixed around 6%. But the next big indicator is going to be June inflation data. So that's our next big sort of thing to watch, and that'll be released mid-July. The Fed is obviously very hell-bent steam out of pricing pressure, which is great. And they're looking to bring inflation back down to that steady state range of about 2%. So if high inflation persists in June, we're in for more to come here. So I'll have John kind of talk a little bit about what this means for the housing market.
Yeah, absolutely. On the simplest level, rising interest rates make home purchases more expensive. This reduces consumer buying power, which then shrinks demand, which all else pulls down prices. For example, for a home that's a $750,000 home purchase, if you're putting 20% down at a 3% interest rate, your monthly mortgage payment is $2,500 per month. And if you're going up to 6%, which is roughly around where rates are now, maybe a little bit lower, you're looking at $3,600 per month. So over a 40% increase. So, you can potentially, obviously later refinance, but on a monthly basis, these sort of 30 to 50% shocks are just not feasible for pretty much anyone. It's paralyzing to potential buyers. And when you layer on top of this, asset price increases we've seen over the past years, buying a house this summer could be, 60% more per month than buying at the same house last summer. And that pressures people to trade down what they were buying, or in many cases, really just bow out of the housing market entirely.
Yeah. So we'll pull up some data here from Redfin. It's where a lot of the kind of freshest off the press data is coming from. This first graph here is really showing that point. So this is the mortgage payment on a median home. And it's leapt in a staggering way over the course of this year. So as John said, this was kind of driven by both the asset price growth that we've seen. So the median home is going up and the rates to finance that are going up. So it's just a really staggering increase and a huge impact on affordability for home buyers. The next graph that we'll pull up here, this is actually a little dated even. This is just through April. But this was showing how the development in asset prices, so that's the blue line here, had already started to diverge really meaningfully from buyers' budgets. The red line here is sort of what buyers were actually searching on Redfin, what they are hoping to buy and can afford. And as people qualify for smaller mortgages with these higher rates, you can expect this pattern to only continue. Like this was 2 months ago, and it's gotten much, much more dramatic.
Yeah, and right now economists are pretty mixed about how this will all net out for housing prices. That's really the big question. Few believe that a significant crash is on the horizon, but it's hard to believe a meaningful cool down isn't finally seeping in.
I'm seeing someone say in the chat that they can't see the graphs. If that's the case, I'm seeing them on my screen, but if others aren't, feel free to message that in the chat and we'll see what we can do. Oh, okay, never mind. Some are saying they can see them. It might be, okay. We've got confirmation we can see the graphs. Okay, fabulous. Keep us posted. This is our first time, so we're still learning. Okay, so like John said, no one's really expecting this to be like 2008. The market looks meaningfully different. The supply-demand balance looks different. Homeowners have more equity built in their homes. Homeowners have lower debt service ratios than we've seen in decades. So we don't have anywhere near sort of the structural stability that we were lacking 15 years ago.
Exactly. But we're still early on here. Where we're definitely seeing the impact already is on the volume of listings and sales. After years of record low supply that we've had, the number of listings has been growing over the spring and into the summer. And by this month, the total number of listings on the market is actually up 15% over last year. So you see that we're starting to accumulate some excess supply relative to tightening demand. You have some skittish homeowners that are trying to take advantage of still high prices. But a gap is really starting to emerge between seller expectations and what buyers are actually able to pay. So consequently, we've seen home sales fall for each of the last 6 months. Mortgage applications are down over 15% since last year. And of course, refinancing has basically gone to zero.
Yeah, makes sense. I think particularly on the demand side, folks are retreating to the sidelines to wait this out. So Jerome Powell basically gave that advice explicitly in his latest press conference. He said sort of to young folks in particular, back and wait with home purchases, which was pretty direct advice coming from the chair of the Fed. There was a great New York Times article a few weeks ago titled, "When the Best Home is the One You Already Have." Essentially saying just this. So as interest rates spike, we can expect folks to simply stay put, or even to be underhoused, which is sort of to live in less house than they perhaps need or want. Because in this rate environment, it can make more sense to maybe renovate your home or expand, add a bedroom, rather than move, because whatever you do, you don't want to give up that low fixed mortgage that you might already have.
Exactly. Yep.
Okay. Changing gears a bit, since all of our Belong homeowners hold rental properties, obviously, what does this all mean for the rental market specifically, John?
Yeah, it's a good question. I think it's tough news for many Americans grappling with inflation. It's actually great news for rental property owners. This is a hot rental market, and it will likely intensify even further. With higher interest rates, fewer prospective home buyers will qualify for mortgages, or at a lesser dollar amount, and will instead choose to keep renting. With rising rental demand, it'll further push up rents. We're actually already seeing that, and with median nationwide rent passing $2,000 actually for the first time ever in May.
Yeah, and pretty clearly the most impacted groups here are those that are getting explicitly sort of priced out of buying, right? It's your first-time home buyers. It's those who would only be kind of scraping a minimum down payment. Those are the folks that are realistically going to keep renting, who might otherwise not have. So that's where the increased demand is coming from.
Yeah, 100%. And but from the homeowner's perspective, with lower and typically fixed rate mortgages already locked in and rents likely to continue rising, yields will improve. So it's a fantastic time to be sitting on a rental property.
Yeah, absolutely. So I think that's a great segue. We're about 20 minutes in, so I think let's start with covering a couple of the questions that we've been getting the most from our homeowners, because like I said, John's been having a lot of conversations over the past few weeks. And then definitely ask your questions in the chat, and we'll start weaving those in as well. I think not surprisingly, a lot of the questions that we're getting have to do with what the future looks like. So are asset prices going to fall? Will rates continue to rise? Might we even see interest rates like those of the 80s and 90s?
Yeah, let's hope not. But let's start with the price question. So far we haven't seen a downward impact on asset prices yet, but it's still early, and it really depends on how long this environment lasts and the extent to which a recession materializes. For now, we're mostly just seeing the transaction volume contract as folks, go to the sidelines.
Yeah. And of course, I mean, like all questions, it depends, right? We were saying this before, but the buyers who are most impacted here are really disproportionately first-time home buyers. For sure, millennial home buyers. It's, these groups that finally were getting to the point that they could get in the game after a long bull market, and they're now mostly going to be sidelined. And for buyers who've already built up equity in the rising housing market, or especially those who can swing sort of a majority or all cash payment, that impact is lessened, right? So you really need to ask what the profile is of that home in that neighborhood. So who are the potential buyers? How constrained is the supply? Because if the supply is constrained, prices are going to be more stable no matter what happens with rates. And in communities that are geared more toward first-time home buyers and have entry price points, whatever those even are anymore, we're starting to see that impact more acutely.
Right. Yeah, what we've started to see is an uptick in price reductions on listings. So, the Redfin data, that you're seeing here on this chart is showing 6% of listings. Other sources show 10%. This represents the highest share of price reduction since, at least 2015. As you can see, it's really rising steeply. Yeah.
And I think within this, I think this gets to one of the questions in the chat around a geographic breakdown, but this number can be much higher if you look at the market level. So in particular, in some of these kind of pandemic hotspots where price reductions, they're now seeping through kind of 40% plus of listings. So I was looking at data from just last week, and the top 5 markets for price drops right now, all of which have reductions on nearly half of listings. That's places like Provo, Utah, Tacoma, Washington, Denver, Salt Lake City, Sacramento. In some ways, not surprisingly, these are the sort of metros that are emblematic of the huge boost that we saw from pandemic displacement, and now seem to be sort of the first and the hardest hit. But it's one of the trickier questions, and we don't sort of hold the crystal ball there. So I think let's do a quick poll of everybody here and say, where do you think housing prices will go by the end of 2023? You should see that on the top of your screen now. There's some who think price growth will continue as it has been, 10% plus, will continue, but at a slower rate, will flatten, will decline, and will crash. Okay, I love seeing all these engagement roll in. So looks like most.
Somewhat optimistic. I'll take it.
Okay, so we have very few pessimists, which is great. I think that, right now, I think, the CEO of Zillow was saying the other day, like, even all of the most tenured economists right now aren't saying the same thing in terms of what might happen next. It's really unclear. Even Jerome Powell is not going to take a firm view here. But not a lot of folks are thinking prices are going to crash. And I think what you'll see is there's a lot of opinions out there that say growth will continue, but at a slower rate. But I think also, we should all be cognizant of a lot of those voices are coming from the mortgage industry, which, they're not in the business of spooking people out of home transactions. So, remains to be seen.
Yeah. No, definitely. And, on the rate side, like you said, expectations for the further rate hikes through the rest of 2022 were, kind of already cautiously priced in. So it's unlikely that we'll see rates as dramatic, as those in the 1980s or 1990s. But, watch for that June inflation report for our next clue to the puzzle. Rates really won't taper off until inflation does. So certainly don't expect to see 3 to 4% mortgage rates really again, I think, anytime soon.
Okay. I think one last one for you, John, before we kind of turn to the audience Q&A. I think one we've heard a lot from our existing homeowners is, is now and this summer a good time to be acquiring rental properties given everything that's happening?
Yeah, it's a good question. I would say so, or at least keeping a watchful eye out for opportunities. After so many years of intense, really competition, there's honestly somewhat welcome relief here, I would say, with cooling demand and fewer bidding wars, coupled with rising rents. We should see some cap rate expansion in the near future, which, essentially means, prices coming down. The question comes down to, what your overall hurdle, rate is given the current market conditions. So, while you'll have to factor in a higher cost of capital when analyzing your next opportunity, the recent upward pressures on rents and the likelihood of, locating an actual attractive single family rental property, again, having that less competition and hopefully better pricing are creating really a more attractive market for acquisitions. Really just another 2 points I want to make and to consider, if you're looking to acquire a rental property, there's a lot of people who are sitting on, on a lot of cash right now, right? Based on what we've seen in, the past couple of years. So, a higher down payment than say the standard 20% to reduce your exposure to these high interest rates is something to consider. This will only help really when running the numbers to see what your rental income will cover when, compared to your operating expenses and your mortgage payments. So, finally, and this may serve as kind of a reminder for a lot of people, but it's important, are the tax advantages to holding a rental property. Having the ability to depreciate the physical structure of the home and the cost of any improvements you make to that house, along with deductions that you can make on most expenses related to operating a rental. So really, all in all, it's, the picture can still look quite good for acquisitions.
Yeah. Okay, let's see here. We're a couple minutes before the half hour, and I'm seeing some good questions roll in. I think based on the original poll of what folks are interested in, I think there were a lot of folks who are just interested in the risk in the broader economy as well. And I think another question we've gotten are, for our homeowners who are lucky enough to have their mortgages locked in at these low rates, like what risks sort of remain then? And I think honestly, the main risk here is that broader economic risk. So as the Fed acts aggressively to curb inflation, we risk sort of tipping the economy into a recession. They're obviously targeting a soft landing, but it's hard to architect perfectly. And I think we're seeing those risks all over the headlines right now. So with that, of course, comes risk as a rental property holder. It's mainly the risk your tenant loses their job or otherwise becomes unable to pay. And shameless plug, I think in times of economic uncertainty, it becomes very powerful to be working with Belong because we guarantee the rent, right? So if we do plunge into a recession, hopefully plunge is a strong word, it shouldn't be deep, but no matter what happens with that resident, your rent will be paid out each month because we have the advantage of operating across a portfolio of big scale. Whereas if you're self-managing, that risk is real because you have really concentrated risk in the hands of a single tenant. It's nice to see in the chat a couple of folks who are echoing that of our current homeowners. Okay, let's take a couple that we're seeing in the chat. Let me try this. Okay, I don't know if everyone can see this. It's our first time using this platform, but should I sell my home now? We get that question a lot, actually.
Definitely a common one. I can take that one, Celeste.
Go for it.
Yeah, it really depends on what kind of cash you're sitting on or what you're going to do with the proceeds of that sale. Realistically, given how tight supply has been, we may still see strong prices for those selling homes right now. But, it really depends, as we said before, on the type of inventory in your market, really. So if you're selling because you need to move or get, more space, it could still make sense to do so, particularly if you've built up substantial equity in your current home or otherwise have a large cash down payment going towards that new house. But if you're selling in order to buy another home and take out a big mortgage, then you're putting yourself in a tough spot. As I laid out earlier, your monthly cost of financing that home will meaningfully be higher.
Yeah, and I think if you own a rental property, which obviously most on this call do, it's hard to make the case for selling it, because I think as we've laid out, and I'm seeing this also in some commentary in the chat, when rates go up, rents go up, because demand for buying is impacted. And so you may not get the price that you're hoping for on the selling side, but if rents are continuing to rise, the outlook for holding rental property really has never been better, especially if you're locked in with cheap debt on the property.
Right. Mm-hmm.
Okay. Trying to scroll through here. Okay. Here's one. Does Belong have a base estimate on what they're recommending rents get increased by on our next renewals? I'm almost using this one to tee up. This is a great conversation to have with us individually, because the impact on rents is so divergent. So depends on the market and depends on the type of inventory and depends on when that renewal is coming up. So we'll run a latest set of comps and really help you dig into that question, because in some places, you take Miami, like the rents are up massively this year over last. In pretty much all markets, it's up over last, but I think with certain markets and certain types of inventory. So in the Bay, for example, we have markets and areas that haven't actually recovered to pre-pandemic levels yet. And you see that in pockets of Southern California as well. So super case by case, and let's definitely talk it out, because it's a really good question to be asking. Okay. Let me do another one. How do these dynamics differ from multifamily versus single family rentals? That is a great question for you, John.
Yeah, this is kind of a loaded answer, I guess I'll say. I think a couple parts to this. The dynamics which affect rate fluctuations, in the residential and commercial loans. And when I say commercial loans for multifamily, that's 4 units or higher, they almost mirror themselves. However, rates for commercial loans are generally, 0.5% or 1% higher, typically across the board. So while the movement of the rate between single family and, call it multifamily, they move very similarly, commercial loans are significantly more impacted by rate fluctuations. And there's a few reasons as to why. The first one is, and the big one, is term. So the average term for a commercial loan is 7 to 10 years. And comparatively, as we know, the typical term for a residential loan is 30 years. So borrowers for commercial loans are forced to refinance or pay off the loan a lot sooner. Another one for commercial loans is prepayment penalties. Occasionally, commercial loans will have to, pay a prepayment penalty during the first 2 or 5 years on the loan. And these come into play should you try to pay off or refinance the loan during, the first couple of years. And very rarely, does a homeowner have to deal with this kind of prepayment penalty on a residential loan, thankfully.
Especially for those of us who have mortgages. Very grateful for that.
Exactly. And, the last risk is, the negative impact of rising rates on, the actual tenant base. Earlier we spoke about the risk of, high inflationary, high interest rate environment and how, what it can do for a tenant base. Well, if you own an 8-unit apartment building, for example, the risk of the owner being more impacted in this environment is undoubtedly higher.
Okay, I'm gonna take this one, but it's a somewhat impossible one to answer. When can we expect rates to come down? it's incredibly hard to say. I think as long as inflation, like John said earlier, continues to be a problem, rates are going to stay elevated. So it could be a year or two, or it could be that some folks are saying we might end up at like structurally adjusting to a higher rate environment. Not high compared to historic highs, but high compared to sort of the last decade at least. The commentary I'm seeing mostly, but again, it's so early, is that 30-year rates could potentially moderate in sort of the 4 to 5% range for the next few years. But again, it's so early that it's really anyone's guess. Okay. I think we may have lost John, but we're also coming up at a little over time. Well, I'll give him a second. You back, John? We got you back?
Sorry about that. Had a little internet crash there for a second.
I've got one more question that maybe you can answer before we wrap. This is a more technical one.
Sure.
Got Jonathan asking, another Jonathan, are there any home equity-based lending alternatives on the radar to help owners leverage the historic yet widely untapped prime rate constrained equity market?
Oh, wow. That is a very good question. As far as what is considered an alternative, I think I would want to speak directly to Jonathan as far as what he's just talking about. And as he's talking about home equity, obviously there are many different avenues you can take as far as getting access to home equity. Obviously typically going to your bank you have your loan with. So I would say that I would want to speak with him directly about that, just because typically you go to your traditional sources and not really alternatives. So I would want to chat with him directly about that and kind of get more information there.
Yeah, I think that there's a broader point too around in this environment where, over the past few years, basically everyone has been getting 30-year fixed mortgages. We will start to see different options kind of coming back on the table. So we've already seen that adjustable rate mortgages, which had gone to basically nothing, are back north of 10% of volumes right now, which makes sense when this is happening. So I think there's probably going to be a lot of sort of creative workarounds that folks are deploying to get financing, because obviously going out and getting a 30-year mortgage right now doesn't make a ton of sense.
Right.
Okay. Let's see. I think that's pretty much everything. I'm just scrolling through. Okay. What is the impact of the big sort of institutional buyers like Blackstone, et cetera? This is a topic we talk about a lot at Belong. I think there's, we've shared data in the past, there's an increasing share of single family homes that are being owned by these big institutions. And we sort of aspire to be the counterweight to that, to keep rental homes in the hands of everyday people and empower small investors. John, you want to talk about the impact of those guys on the market right now, or how they're faring?
Just the Blackstones basically, and the big institutions, they're going to operate differently though, and they're typically taking a long-term view and holding out for the long term, so that provides some stability, and if that continues to be the case, there's no reason to expect them to be unloading homes when rents are up. They also may be looking to buy more in this period, since they may have substantial capital to deploy and aren't as impacted by changes in rates. So unfortunately, those sort of buyers will have a leg up on the normal home buyers, in my opinion.
Okay. I think it's a reality we're all stuck with for now.
Yeah, unfortunately.
Okay, so I think this is all the time we've got now. And we've answered, I think, most of the questions here in the chat, but please do reach out if you, particularly if there's, again, individual questions or where it would be helpful to kind of run numbers on your property. I think we're always happy to do that. I really want to thank everybody for coming. Again, this is our first run at doing a webinar here at Belong. I think this is a juicy topic and we could discuss all day. So we'll do more of these. It was awesome to see, 80 plus people here. I think there's a lot of folks interested in this topic and, it'll continue to unfold this summer. So again, don't hesitate to reach out with any questions and we'll talk soon. Thanks, everybody.
Thanks, everyone.